Why is the first mortgage payment 95 interest and 5 principal? Why is the amortization schedule that it is? Why can't banks split it proportionally so that all 360 payments regular mortgage have the same principal and interest payment? Because you pay interest on the current balance. Say you borrow $240,000 at 10 interest, the first month's interest will be about $2,000, $240,000.1012. So if your principal and interest payment is $2,500, you'll pay $500 principal that month. Some years later you'll owe $120,000. Then you'll be paying about $1,000 more in interest, and $1,500 of that same $2,500 payment will go towards the principal every month. Years later you'll owe $12,000 and only $100 more will be interest. Because you accrue more interest when the principal is larger. You're the one who wants to make the same payment over 30 years. Because interest is a percent, so the amount will be larger when you owe more money. You can always change the by paying extra. For example, if you fully pay off the mortgage in the first payment, it will be almost all principal. Because you wanted to borrow money for 30 years. The bank takes the interest rate and works out what the monthly payment would need to be, so each of the 360 monthly payments is the same amount while accounting for the interest owed on the remaining principal. Because the math won't add up the way you suggest, tears of joy, tears of joy, tears of joy. Go take a gander at your amortization schedule. Also, whenever you refinance, you're reverting the clock again. So the interest payment will again be front-loaded. You'll pay more interest than principal at the start of the loan. Your mortgage payment is the same every month. So because your payment is the same, but your principal is high, you're mostly paying interest. If you put $20,000 towards your mortgage today, your next month's payment amount would remain the same. But because the principal is lower, you'd be paying less interest. Think about it like this: you always pay $1,000 a month. The bank calculates how much interest you owe, and then whatever is left over goes to principal. At the start of a mortgage, because your balance is super high, very little is left over. The payment is an irrelevant number to the mortgage. All a payment is a calculated number such that you pay off the mortgage in 30 years at X interest. In other words, you think the payment is what is being set. It is not. The term and rate are what is set. The payment is just the result of that. Yay, you'll enjoy the payments not being proportional when you cross that barrier where your interest payments are greater than your interest payments. Pro tip: makes extra payments of your principal payment amounts and yield that month's interest payments. Hope that makes sense. But every additional principal payment knocks months off your term and gets you to the better side of the payment ratio. If you get a 15-year mortgage, you pay more of the principal each month and can save substantially on interest. Not only are the rates lower, but because you're only borrowing it for 15 years instead of 30, you pay less interest at the beginning too. Because the last one is 5 interest and 95 principal. Banks want the fees for closing your loan, make bank for 5 years and hope you refi. You have discovered the justification for fixed-rate mortgage. For the bank, fixed-rate mortgage is front-loaded. The risk is high, but most income comes in the beginning. As years pass, inflation erodes mortgage profits. But most profits have been realized on books. Since it is a fixed-rate mortgage, the graph will be a line from first to last interest payment. Because your UPB generates interest, you're free to make additional principal curtailments if you want to pay more of the balance down. I'm pretty sure I thought a 3.5 interest rate meant I would pay $517,500 for a $500,000 house well into my 20s. Interest is always charged on the outstanding balance. And that's higher at the start than at the end. This is why making a large lump sum payment early can reduce your total interest paid a great deal. Though most can't afford to do so. I mean, you can do that yourself if you front-load it by paying extra principal. Fixed payment mortgages by definition have to have front-loaded interest for the reasons others have mentioned. Can you pay more to the principal? Fundamentally, you should think of a 30-year mortgage as a collection of 360 loans. The interest is calculated on the amount of the loan balance for that month. Every month. Since the principal drops a little every month, the interest does too. Thus, more of your fixed payment shifts from interest to principal. The mortgage amortization schedule is annual interest calculated monthly. That means you calculate the balance times the interest rate, then divide by 12. That is how the math works out. Lol. Because you put little to nothing down, have a high interest rate, and got the longest possible mortgage term. This is how amortization works. Payment to principal goes up as loan balance remaining goes down and payment stays the same. The explanation here is really too reasonable to learn more. Changed. I was wrong. The banks want their money first before it goes into your pockets. Making extra payments on mortgage makes a significant savings on interest, especially in early stage. Because money now is worth more than money later, so the banks want more upfront. That is the way amortization works. You're paying interest on the principal amount of the loan remaining. That's so that the banks can make sweet money from you with these products. They make all their money up front. Another dirty secret is that they use the previous month's balance to calculate the current interest payment due pouting. So the bank gets paid sooner than later. I'm happy to see most of the comments are positive and supporting the commenters that have helped provide of shitting on people who didn't understand this in the first place. Faith in the internet is mildly restored. 1 to evidence on the state of financial literacy and the need to teach it in HS. That's not how interest works. There is so much ignorance on this post. As others have stated, at the beginning of the loan, you owe the most principal. That means that you also have the highest interest cost as you pay down the principal balance over time. The amount of interest you owe also goes down because you are borrowing less money. It's not some scam run by the banks. That's not how amortization works. The amount of interest you pay is based on the outstanding loan balance. Get out a spreadsheet, put in whatever your loan is for, then make a formula to add whatever your interest rate is. 360 months later, the amount you have is equal to the cost of your loan. Basically, it's reverse compound interest. It's simply the way interest works. All forms of loans are front-loaded with more going to interest initially due to the balance. Your PI payment doesn't change. Because that is how math works on 30 years of principal pay down. LMAO, OP has no idea what interest means. Because the interest amount depends on how much money you own in the principal. On your first payment you still owe a lot. Do you pay a lot of interest in later payments? You have already amortized a lot of the principal. So the interest amount over the principal is much lower. It's a business. Just another way to keep the people enslaved. Double your payments and make them pay the interest. Always overpay on your mortgage to dramatically reduce how much interest you pay over the lifetime of the loan. How else would banks make money off you? Compound interest versus simple interest. That is how interest works. Amortization.